I think, as I was saying earlier, I mean, our job is to actually match buyers and sellers of a product, and we have some people who believe the Dow is going to go up, and some people believe the Dow is going to go down, and we will match those trades against each other. What's really important, though, is for the client to make sure that they're dealing with an organisation where they believe that if they look at a Reuters screen or a Bloomberg screen, or they look at a publicly available piece of information, that the price that they are being offered on the platform is the same as that which is in the marketplace. I think that you have to, because from the customer's point of view, providing they're being offered a fair market price, should they really care about whether their trade is being matched against someone who takes a contrary view, or should they care about whether their trade is being put into the marketplace? What I think is important going forward, and it's part of my view in terms of platforms, is that we should be able to offer our clients the opportunity to either have a match trade where they're matched, where we're looking at buyers and sellers versus putting a trade into the marketplace. But people have to recognise that if we are putting a trade into the marketplace, that is a more expensive proposition than a match trade, and therefore you're priced differently. The first thing to recognise is that, spread betting is a tax layer that is specific to the UK. What we're really talking about is a form of trading which is contracts for difference, a leveraged trade. Now, I think that if people are investing for long-term value protection, then people tend to invest in the underlying equity. So they will buy £1,000 of BP shares, and they will sit there and they will benefit from the dividend flow, and they'll benefit from the long-term growth. But if someone has a view that BP is going to, as a result of something they've read in the newspaper or some opinion they've formed, that the BP share price is going to move very quickly over a relatively short period of time, or the Dow is going to move, or the FTSE, or the dollar yen, or any other tradable item is going to move very quickly, then leverage trading, where you can take a bigger position than you might be able to take in the underlying asset, is a very effective way of being able to create wealth rather than protect wealth. Because if you think about it, the way a spread bet works is it says, right, I would like to bet £1 a point that the BP share price is going to increase. And therefore, every penny that the BP price goes up, you gain £1. Equally, if it went in the opposite direction, every penny the BP price reduces by, you lose £1. And we were talking earlier about stop losses, and that's where you can automatically set limits that say, once I've lost £10, that's it, I want to stop, or once I've made £10, I want to take a profit. So by taking a leveraged position and taking that betting layer, but underlying, it's the same as saying, I'm going to buy 100 BP shares, but that might cost me several £100. This allows you to get the same benefit as owning 100 BP shares, but by taking a leveraged product. What is important, though, is to make sure that you have a degree of leverage, which means that you're not going to be in a situation where you're stopped to trading because there's been a significant move in the marketplace. Because some product can move very quickly. So the BP price might end higher at the end of the day, but it could go down 10p, up 10p during the day. And it's those rapid movements that often cause people to, in industry parlance, get stopped.